In 2022, interest rates were pretty much zero, and we went to 4% pretty quickly. So again, we don't necessarily know the exact path of when the Federal Reserve will stop hiking rates, but one thing we feel pretty comfortable with is that we are closer to the end of a Fed hike cycle than we are at the beginning. As far as whether we enter a global recession or not, that also is yet to be determined. There is no doubt from listening to many companies globally that there is an economic slowdown happening, and many companies are reacting immediately to that global economic slowdown by stopping ordering, stopping hiring, and in some cases we're beginning to see an acceleration of layoffs. A scenario where we are possibly past peak inflation and closer to the end of a Fed hike cycle, that could be positive for the income and growth portfolio.
What does this mean for the American Income Fund? With over 80% of the assets, 50% US investment grade and 30% US high yield, trading at significant discounts to par, we have the ability to provide total return within the portfolio, and in doing so without taking excessive risk. The return profile for the asset class typically, after a negative year, has positive returns, and in many cases has multiple years of positive returns. In addition to that backdrop, we also have a very strong fundamental backdrop. You have credit balances or cash balances at all-time highs, you have leverage back to below levels where it was prior to COVID, and you have interest coverage levels at all-time highs as well. With the backup in interest rates, if you look at where we are today with a yield of 5.75%, that's relative 2.4% to start the year. We're able to buy new bonds, add them to the portfolio, over 300 basis points increase in yield and interest. So we continue to be very positive on the asset class.
For 2023, the team favors investments in services-oriented businesses driven by increased mobility and households moving from the purchases away from goods and the acquisition of things to experiences. Those experiences include leisure activities, entertainment, and travel that over the past 2 years were restricted due to COVID-19 protocols, with those barriers now removed. Most likely see an increase in 2023 default expectations and underscores that active management in short duration is critical to avoid distress and downside performance. In a volatility market, it presents an opportunity to build income portfolios at a discount to par. The U.S. short duration strategy can accumulate securities at a discount with fewer years to maturity, providing returns from high coupons and price appreciation, and actively manage to steer away from the unwanted price volatility and avoid distress and the risk embedded in passive approaches.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。